Multitimeframe analysis is a trading principle that allows traders to increase their chances of finding a reliable trade opportunity by acquiring a broader and more sophisticated view of what's happening in the market. The idea that holds multitimeframe analysis in place comes from chaos theory, and it's called fractal analysis, which can be extrapolated to all chart techniques in one way or another. Chaos theory is the theory that claims that apparently random and chaotic systems are not random at all. They just function within a higher degree of order that is not obvious at first glance. From that point of view, the appropriate way of analyzing a chaotic system like the markets is by breaking it down into smaller components. This is where the idea of fractal analysis comes into play. The word fractal means pattern that repeats inside itself. If we analyze the market under this light, we can actually start to make sense of what we see on a price chart because we can break down a complex system into smaller and simpler components that later will come together again to form a context for trading decisions. It's folk wisdom that price does the same thing repeatedly in all timeframes. The only thing that changes is the degree and the time it takes for these same patterns to develop. The fact that we can access multiple timeframes in our price charts is great, because that's how we can apply the concept of fractal analysis into our trading. This application has the effect of increasing the depth of analysis to a sustainable degree. Remember that the markets are a complex entity, so it is virtually impossible to know what is going on by taking a quick look at it. This idea of the fractal breakdown of price patterns really helps to pinpoint precise moments of likely reversal in price. For now, it is important that you understand that multitimeframe analysis is the gateway to applying the fractal analysis to the markets. That's the case because by using multitimeframe analysis, we can look at the same segment of price in different degrees. Let's observe a simple and conceptual example of what that means. For example, a large price movement analyzed only under the 4-hour timeframe doesn't show too much information about the smaller components of its internal trends. If we analyze the same price movement using a lower timeframe, taking into consideration the 4-hour timeframe as a contextual starting point, we can see multiple market edges that would not be visually available just by looking at the 4-hour timeframe only. However, a trader must be careful when using this idea because we can extrapolate it to extreme degrees, and it's not really obvious when it's the correct time to stop this extrapolation. That means that multitimeframe analysis has its advantages, but it also has its disadvantages. For example, extrapolating this idea in too many fractals can lead the trader to something called analysis paralysis. Analysis paralysis is when the trader tries to make sense of too much information about the market up to the point where he freezes and doesn't know what to do. On the other side of the spectrum of analysis paralysis, we have something called objective blindness, which is what happens when the trader doesn't have enough information about the market. That usually happens when the trader tries to use simple indicators to smooth out the nuances of price data. The correct application of multi-timeframe analysis is supposed to keep the trader in the middle of this spectrum, where he has just the right amount of useful information to handle his trading ideas. It can be a little hard to understand these ideas conceptually if you have never messed with them in the practical sense, so don't worry too much about that for now. It will get a lot clearer when we move on to the practical examples. In the next lecture, we are going to explore the concept of hierarchy of trading signals between different timeframes.